Great. So welcome everybody. I just want to make sure that you're viewing me in speaker view right now. So my name is Julie Dirksen and I'm the Supporter Relations Manager here at Canadian Foodgrains Bank. And we're working through a Zoom surprise. So we just want to make sure that our perspective is okay. So Stephanie has you in speaker view. And I should be the person that you see in the middle of your screen as I'm speaking. If that's not the case, could you let Stephanie know so we can try to figure that out so you get the best possible experience of the meeting today? All right. So yeah, I want to welcome you here today. This is a bit of a different topic of webinar for us that we haven't had before. But there's a number of reasons why we decided to kind of offer some resources. Okay, thanks, Margaret. To offer some resources for actually, Margaret, for any of you who are watching too, you can also change your own view to speaker view on the top right-hand corner where it says view. If you click on that button and then click onto speaker, that should also change your point of view. Okay, great. So the reason for this webinar is partly because at the Foodgrains Bank, we've really tried to put a stronger emphasis on impact because we understand that impact is important for our supporters. We've seen that through the 4-to-1 grant and how folks really resonate with the idea of their donations being matched by government donations or other donors. And some of the types of gifts that we're going to talk about today in terms of planned giving really have tremendous impact, where you can make what is a normal donation and you can maximize the impact of that donation because it can have a value in the future or tax savings that increases kind of how that impacts our program areas. And we recognize that a lot of our supporters are wrestling with these conversations right now. They're thinking about how to maximize the impact of their assets in their charitable giving. So we've heard that, and we want to provide an opportunity to give some information to people about this. And we get a lot of questions from supporters about this. When we are talking to people, our reps receive calls from people asking, do you take bequests? Do you take gifts in your will? What does that mean? Do you take securities donations? Yes, we do. And but people have a lot of questions about that. And we wanted to provide an opportunity to answer some of those questions. We have noticed in the past 5 years an increase in the number of securities being donated to us, and that has got almost doubled each year. The amount of people who choose to donate securities because of some of the tax benefits of doing so has really increased. We've also noticed an increase in donations from donor advised funds, where a foundation or a particular organization manages those charitable bequests and doles them out on behalf of the supporter. And Harold will talk more about donor advised funds in his presentation. And we also get many questions about what we accept. For example, we accept securities. In fact, there's a page on our website which can describe how to donate securities. We also get bequests each year, an increasing number of bequests of people who leave gifts for us in their will. We sometimes received gifts of land in somebody's will. So a variety of things. If people have questions or specific concerns, we often try to answer those questions for them. But we also recognize what we are not able to do. We cannot provide specific information or advice. We always refer people to their financial planner or an accountant when they have specific questions about these kinds of gifts. So that's why we've invited Harold here today. Harold is a gift planning consultant with Abundance Canada, and he'll tell you more about Abundance Canada. We receive a lot of funds through Abundance. We work with Abundance regularly in our work. And that Abundance is one of a number of foundations that manages gift planning. He will describe some of these products and the importance of those. So Harold, I believe, has a presentation that is about 40 minutes long. If you have questions, please put them in the chat. We will monitor the chat and bring those questions forward to Harold so he can answer them, and we will leave some time for questions at the end. And finally, this presentation will be recorded so that if you want to recommend it to someone, they will be able to watch it at a later date. So at this point in time, I'm going to pass it over to Harold. Harold, thanks for coming, and it'll be good to hear from you today.
Thanks very much for the introduction and for the invitation, Julie. We're going to try getting a screen share going on here. So I've got something up and just want to confirm if you're seeing a screen saying planned giving and you. Is that what you're seeing? Are you able to hear me?
We can hear you, but we can't see your shared screen, Harold.
Okay, so let's try that again here. Are you seeing that?
Yep, now we see it.
Okay. So it should be a full screen with a couple people and plan giving and you on the side there. That looks good. Excellent. So it's great to be able to join you today. I'm going to be sharing a little bit about planned giving, and as Julie said, there's a number of types of assets that are beneficial to be considering gifting, and so we want to look at some of those as well. So hopefully you find this information informative and helpful, and if you have questions, as was mentioned, you can either put some notes in the chat or jot some notes down, and when we get to the Q&A at the end, we'll have some time to address those as well. So my next thing will be, there we go. So a little bit about Abundance Canada. We were founded back in 1973 as Mennonite Foundation of Canada. Some of you may recall that name from the past. We changed our name in 2016, and that was to reflect our desire to help anyone. We had many people who wanted to use our services, and the name was a little bit of a hindrance in some cases for people. And so the name change was to reflect our openness to work with anyone who wants to use our services. We do have offices across Canada, from Kitchener, Winnipeg, Calgary to Abbotsford as well. And so I'm not sure where everyone's from, but if you're not from Manitoba, there may be an office closer to you in one of those other locations. We do have 23 staff across our organization, and 9 of those are gift planning consultants. So those would be the individuals who could work with you. At the end of 2022, we managed $240 million of assets. And in that year, we had issued donation receipts for $48 million. And so there's a fair bit of activity that we do manage in any particular year, and that's reflected in those kind of numbers. As I said, I'm a gift planning consultant, and I and my 8 colleagues who are gift planning consultants do work with individuals, helping you think through your gift generosity plans, and those tend to be a work in progress. So we might start at a certain stage and things change over time, and so we work together with you as you make your plans. So today what we want to be looking at is just a bit of a definition of what planned giving is. There's some different perspectives on that. We're going to explore some of the tax efficient giving options out there, which may be beneficial to you. And then we'll look at some of the benefits of gifting to charity in a will. And then we will have a Q&A at the end. So definition of planned giving. For some people, planned giving is strictly the idea that we are going to include charity in our will, and that's the extent of what planned giving is. But we consider planned giving much broader than that. Planned giving is essentially any gift that we have to plan in advance. So it's not just the reaction to the request at the store checkout or somebody on the street corner, but it's us looking at what is it that we have in terms of our assets or our income stream. What are our values in terms of the kind of charities that we want to support, the kind of social program we want to support, and then how are we going to match some of our assets to those kind of endeavors? And will we do some of that during our lifetime, which is one time to be generous? Will we do some of that at the end of our life through our will or beneficiary designations? Or are we going to do both of those things? And so planned giving incorporates all of those different kind of aspects as well. So what kind of what kind of assets can we donate to charity? And here's some of the main ones. Cash, of course, would be either cash, check, and electronic fund transfers. Maybe credit card is fairly common now, or debit card. The next would be publicly traded securities, as Julie mentioned, and those would be stocks, bonds, mutual funds, exchange traded funds, would all be options that are included in that umbrella of publicly traded securities. Another one is life insurance, which we'll talk about as well. Registered funds, RRSPs, so registered retirement savings plans, registered retirement income funds, or tax-free savings accounts. All of those are registered funds, and we can name beneficiaries of those kinds of funds. And then another one that is a possibility is private company shares as well. We're not going to get into that today, but that is another possibility as well. So Julie mentioned that a number of your donors to Canadian Food Grains Bank used donor advised funds. So a little bit of an explanation of what a donor advised fund is. We tend to think of it as it's a parking lot, and is a good analogy. So you can donate money or these different kinds of assets at any time, and you'll get a donation receipt, and the cash proceeds are in this parking lot. And when it's in that parking lot, you can now decide, does it go out immediately? Is it going to sit here for a while and then go out? Maybe you can have it go out over a regulated time frame. So there's a variety of options there in terms of how that works. So there's a lot of different public foundations that do offer donor advised funds. That's become more popular in the last 20 years. And each foundation has its own set of rules. In terms of CRA, they're fairly wide open in terms of how a donor advised fund might operate, but each public foundation that does offer it has their own rules for various reasons, and it's good to ask questions if you're considering a donor advised fund and checking with different organizations that offer it. What are the requirements? What are the rules around how they operate their donor advised fund? In some cases, it might be earnings only that can be distributed. In other cases, the funds can come in and go out at any time. And then as well, the cost associated with using a donor advised fund, there's different fee structures with every different organization has different fee structures as well. So it's important to ask questions of the organization that you might choose to work with. At Abundance Canada, we've chosen to refer to those funds as a gifting fund. So if somebody comes to us and wants to open a fund, we'll refer to that as a gifting fund. What are some of the reasons that people might want to use a donor advised fund or a gifting fund? In some cases, they might want to donate now and distribute later. So it's a timing issue. They need a donation receipt in this tax year, but they're not ready to make that the distribution of those funds all at one time for a variety of reasons. Some might want to use it to be anonymous. So we find the majority of our donors have relationships with organizations like Canadian Food Grains Bank and want CFGB to be aware that the money is coming from them because of that relationship. So they will not be anonymous. But there are some who choose anonymity for a variety of reasons. And that's an option through a donor advised fund. It also allows them to streamline some of their charitable giving. And so they can do, instead of maybe supporting 10 different charities and at the end of the year looking for their 10 different donation receipts at tax time, they can do one donation to their donor advised fund, have that fund distribute those proceeds over time, and they are only looking for that one donation receipt come tax time. So there's some simplicity for them as well. And other people might want to create a family fund, and so they might either fund a fund themselves and include their family in terms of distribution decision making, or they might have all family members contributing to one fund and then together make decisions around distribution. So there's different reasons why people might choose to use a gifting fund. Coming back to um, some of when you would use a gifting fund. So indecision was one of those. So unsure which charities you want to support, and this would be one where somebody has funds available, wants to make that donation, but they have not fully decided on where they want to distribute those funds to. Perhaps it's a larger sum of money than they typically would donate, and so they can park that money, like we described earlier. They can park that money in the donor advised fund, and then have time to finalize those decisions. And it might be that they're waiting for they know something big is coming up with an organization. There's a project that they want to fund, but it's not ready yet. And so this would be a way of having the funds available when that project is available. There's also the tax efficiencies that they'd be looking at. So stock market gains. Julie mentioned that you can direct gifts in kind to Canadian Food Grains Bank, and they can process that themselves. There's a lot of other charities that aren't set up to do that, and so you can use a donor advised fund to gift securities and then have the cash distributed to those funds as you're ready. And so it simplifies your giving. It also makes it possible to distribute those funds to any charity. Another tax efficiency is when people are selling land or selling a cottage and they have a tax bill associated with that, they can offset that tax by making a larger donation to a gifting fund and then have those funds available to distribute later. But it allows them to match their tax bill to their donation receipt in the same year. That can also happen if we're selling a business or selling a farm where there's significant capital gains. Same scenario happens there. And then there's some other people who perhaps they have a windfall like an inheritance. It's money that wasn't expected. It's a larger sum of money, and they have the ability to make a larger donation than normal. But perhaps they want to be able to spread that out over a few years, but they need the they want to do the creation of a larger sum, a larger fund, and then have time to distribute it. So those are some of the reasons why people might choose a gifting fund as well. So here is a scenario of how that works. You can make for instance, a $25,000 donation to a gifting fund, and you get a donation receipt at the time that you make that donation. So it's April of 2024. Now you have your 2025 or your $25,000 tax receipt because you made that $25,000 donation. And once that's done, separate from that, you can decide, how do I want to distribute those funds? You might say, I want to have that all go out to charity immediately. And so perhaps there's a list of 5 or 10 different charities that you provide and say, please divvy up that amount that I donated and have it go through immediately. You might say, I want to do that later. So through the year, I have different distributions I want to make through the year or through a number of years. And so the money is already sitting available to distribute. Or you might say, I'd like to distribute this quarterly or monthly or some kind of a time frame so it continues to provide that regular support to the charity that I support, and it's automated, so I'm not sitting down and writing checks once a month or once a quarter, but I know that it's being taken care of. And so that's how that kind of scenario can work. If the money is going to be sitting for multiple years, it's also possible to invest it and have some growth to the fund or have earnings that are distributed annually as well. So gifts of securities was mentioned, and we're going to look at a little bit more detail around that just to explain that. And as I said before, that's stocks, bonds, mutual funds, exchange traded funds. Um, and it can be segregated funds in life insurance, offered by life insurance brokers as well. Here's a fairly typical scenario that we would bump into. We'll call these people Ben and Brenda. They typically do $20,000 a year of donations in cash to a variety of charities. And those charities know and expect that some funds will come from them, and they have those relationships with them. They were looking for some way to simplify their generosity, and in their discussion with their accountant, were describing that they had non-registered public securities that had increased in value to fairly well already. And the accountant suggested perhaps you would like to have a conversation with Abundance Canada and make a donation. Instead of donating cash, you could donate some of those securities uh, instead. And so we had a conversation with them, and this is the kind of scenario we would be looking at, where they have two options. Instead of doing cash, they could take $20,000 of investment and sell it. Their original cost on that, they initially purchased $4,000 of an investment. It's now worth $20,000. So they have a capital gain of $16,000 in this scenario. They would be taxed on 50% of that. So $8,000 would be taxable. And their tax rate in Manitoba, the top marginal tax rate is 46%. So we'll assume that they're in that tax bracket. They would have tax payable of $3,680. They'd have a donation receipt of 20,000. That's the amount that they had donated or are going to donate cash. So they'd have a tax payable in that scenario where they sell and donate cash. Their alternative is they can donate the securities in kind. That means what they do is there'll be a transfer form that they'll fill out. It'll indicate which securities that they are transferring over to charity directly in kind without selling it. Those, let's assume they're BCE shares. worth $20,000, that will be transferred in kind to the brokerage account of the receiving charity. They'll still have a $4,000 cost to that donation. They'll still have a $16,000 capital gain, but the capital gain is zero rated for tax purposes. So they'll still report it on their tax return, but they'll indicate that it was a donation in kind to charity. There'll be no tax payable on that $20,000 of in kind donation. They'll still have a $20,000 donation receipt, and they can use that against other income. So they benefit to the tune of $3,600 and change by doing an in-kind donation. So it benefits them up front. And for some people, what they then do is take the $20,000 of cash they would normally donate and they would reinvest it. And so they will be upping their cost base on their investments as well. So an extra potential win for somebody who has these kind of assets and wishes to donate them. What we find, the majority of in-kind donors are in their 50s or older. They've accumulated some investment funds, which now have significant capital gains. And this type of donation, of course, has the tax benefits. We also find many retired individuals are donating from assets. And so if they have these kind of assets instead of cash, they can donate these instead. And this type of a donation will also not only benefit them now by not paying capital gains tax, it'll also reduce their future tax bill on their assets, or sorry, on their estate, because they've dealt with some of that up front. The other option is that you could um, choose to benefit charity in your will and have a conversation with your executor to make sure that if you have these kind of assets, that's the first place they look for making in-kind donations from your estate, because that'll help to offset your estate taxes as well. So you can gift these during your lifetime. You can also gift them through your estate if your executor is aware of that option and makes use of it. We'll look at gifts of life insurance. So life insurance gifts, that's typically the insurance that is beyond what an individual needs to fund their own estate or to protect their families, and they may choose to donate that insurance policy. And there's three different scenarios that we bump into on a regular basis. One is, oh, and I'll back up and maybe just provide a few terms as well, just for some background. The type of insurance policies, there's term insurance, which is valid for a set period of time, 10, 20, 30 years, and it can be renewable. Those aren't typically the kind that are donated. It'll be more the whole life insurance. So whole life policies are insurance policies that are guaranteed for the life of the insured person or persons. There's generally a consistent premium payment through the life of that policy, although some may have what's called renewable, either annual or every 5 or 10 years, an increasing cost of insurance. And so that becomes a factor in maybe determining what you want to do with it. The life insured is the person or persons whose life is insured. It can be one person, it can be two. In many cases, a couple may have a joint insurance policy, and it might pay out when the first one passes or when the last one passes, depending on what it is that they want that life insurance for. If they're donating to charity, many times it would be the joint last to die scenario. So when the second one passes, a life insurance payout then will go to charity. The face value of a policy is what the insured value is. So maybe $250,000. which would be paid out when the insured passes. And face plus would be the face value that's insured values that's going to be paid out plus a calculated cash value that's in the policy as well. Cash surrender value in a life insurance policy, those that have an investment component that grows over time, and so there's a cash surrender value in some cases, that if a policy is then going to be surrendered, they know that there's this amount that's available um, to pay out to you if you surrender the policy early. And then fair market value is a calculation of the present value of a policy based on whatever that face value is and the life expectancy of the life insured. And this is calculated by an actuary to determine the value at time. And that can be either when a business is transitioned that has life insurance in it, or when you're donating a policy, there needs to be a calculation of what is the fair value. So let's look at 3 different scenarios that I have listed here. The first would be gifting a new life insurance policy. Why would somebody want to make a donation of life, like purchase a brand new policy and make a donation of it? The donor might want to ensure a gift to charity on their death. So they may not have a lot of value in their estate at this point. And so this is a way of either maybe perhaps increasing the value, or at least having a set dollar amount. We know I've got this $100,000 policy that I'll pay to charity. Or they might want to protect the gift from being contested by other potential beneficiaries in their estate. So whatever your will says, a beneficiary or potential beneficiary could contest that, but the life insurance payout is paid out directly to the beneficiary outside of the will, and so that can't be contested in the same way. It can also ensure a quicker payout to the charity or the named beneficiaries, typically within 30 days of the death certificate being provided to the life insurance company. The life insurance proceeds are paid out, and so there's a quicker turnaround on those funds, whereas the estate might take perhaps a year, perhaps a couple of years, depending on the complexity of the estate. In this case, it's also that the individual needs the receipt for the estate versus during their lifetime, and so they might be wanting this kind of a policy to offset taxes in their estate. Typically, the individuals are going to choose a new permanent life insurance policy, and they'll donate it to charity. The policy won't have any cash surrender value because it's a brand new policy, and so there's no donation receipt at the time of the donation, nor will there be one on death, because this is a policy that has been donated already up front. However, the donor will pay annual premium payments, and they'll get a donation receipts every year for the donation or for the donation of the premium amount. And that might be the perfect scenario for some people. So common scenario we find, this would be younger donors who might choose this kind of a donation of life insurance. And it can be individuals with smaller estates who wish to increase the amount for charity. So we recently had a couple who were nearing retirement. They had a limited estate size, and they had a number of children who were going to benefit from their estate, but they wanted to make sure that there was a set amount that would go to charity. And so they purchased a brand new policy. They donated it immediately to Abundance Canada in order to guarantee that amount that would be available for charity. Considerations: there's no donation receipt at the time they donated it. They will receive an annual donation towards the premium payments, and they don't need a donation receipt in their estate. So that's a good scenario, reason for that kind of a scenario. The second one is gifting an existing policy. So, why would somebody do that? A donor may have existing permanent life insurance which isn't needed any longer. Perhaps they uh, typically, as we age, we get to a point that we have enough other assets, so the need for that life insurance policy is diminished, or business people have the need for insurance within their business as they're growing their business, and as that business matures, the need for that insurance is decreased or is no longer needed at all. And now that they've made payments for many years, they may look at that policy and say, I could cancel it, but maybe there's some value there if I would donate it instead and benefit charity. Depending on the scenario or the situation for the donor, they'll be received either the cash surrender value or the fair market value of the policy at the time of the donation. So it's a conversation that needs to be had at the time. The receipt offsets any tax that's payable on the policy value. So there may be some taxable income that's calculated when that policy transfers ownership. And so the donation receipt will offset that. And there will be some excess donation value, which can be used against other taxable income in the year of the donation and can be carried forward up to 5 years. The donor will also receive a donation receipt for any future premium payments that they make. So they may have a paid up policy, but in many cases, they may have a policy that they're continuing to make annual payments for as well. So common examples that we find: older donors with comfortable retirement incomes who no longer need life insurance to offset or to supplement their estate. They may choose this kind of a route. Or business people, as I said, they no longer need that extra level of insurance in their business, and they may choose to donate that policy. So a scenario that we had recently around this, we had an individual, we'll call her Olga. She was 82 years old. She had two life insurance policies, and they were each worth $1 million. And she wanted to make a donation. So she had them valued, and the one particular one had annual premiums of about $20,000 a year. It had a cash surrender value of just over $15,000. And the actuary determined that the fair market value of the policy was $649,000. So roughly two-thirds of the insured value of the policy. She chose to donate the policy, and we issued a donation receipt for the $649,000, the fair market value. And then in consultation with her advisors, she wound down her RIF holdings and used that donation receipt to offset the taxable income. So it allowed her to deal with a significant tax bill instead of waiting uh, till she passed and it was dealt within the estate. She was able to deal with that tax bill during her lifetime, which was going to simplify her estate down the road. And then with those RIF funds now having been cashed out, she had other options with what she would do with those RIF uh, proceeds as well. Around the same time, we had a different conversation, this time with a male who was in his early 70s, so about 10 years younger. He was also in good health, and he also had $1 million policy. The cash surrender value was a little bit more in his case, about $60,000. And the actual actuarial value in his situation was about 300,000. Why the difference? Because he's about 10 years younger than Olga. And so there's that much longer before this would typically pay out based on typical lifespan. So he looked at that and in his case decided the timing wasn't right. He would hold on to that policy. But we can have those conversations with individuals about, does it make sense to donate a policy during lifetime, and what's the benefit or not. I'll take a little bit of time to look at naming charity in your will. Um, and naming charity in your will, or your will, is essentially your final value statement. It's saying what's important to you. So in this case, Anne is an individual in her late 70s. She has two children. She's wanting to support charity in her will, and she has multiple charities she wants to support. Some she wants to benefit immediately, others she wants to benefit over time. There's a possibility of future changes, perhaps in creating an annual scholarship for fund for the school that she attended when she was younger. So she had a conversation with her lawyer, and her lawyer suggested, well, we can incorporate this all in the will, but you could make it simpler by just naming a donor advised fund like Abundance Canada. They will receive the charitable portion that you've named in your will, and then separately you have a conversation and you set up an agreement with, in this case, Abundance Canada. So the charitable gift, when she passes, the executor will be able to have one amount that they distribute to one charity. So this, the estate settlement will be much easier for the executor. They will then be able to use the donation receipt against the taxable income in the estate. But she will have had instructions now, in this case with Abundance Canada, on how to distribute those funds. Here's 3 charities I want funds to be distributed to immediately. Here's 3 other ones. This is a large sum. They're smaller charities. I don't want to impact their annual operating negatively. So let's provide support over 5 or 10 years. And then there's also the ability for her to have a conversation with that school and say, I'd like to create this scholarship fund. How can we do that? And the donor advised fund will provide annual payments for that award every year, but the award criteria will be arranged with the school that's going to be receiving those funds. And those different kinds of arrangements can be adjusted over time. That's the benefit as well of using a donor advised fund. You don't have to go back and rewrite your will every time you make an adjustment. You can just have a conversation with Abundance Canada or your donor advised fund. It allows you to be more strategic in terms of what you want to do. So here's a bit of a graphic in terms of how you can deal with gifts to charity in your will. So typically you would name, in this case, 5 different charities, and your executor would need to deal with 5 different charities when they're making distributions, and each of those charities will get some portion of, or the whole will that will, if it's a set dollar amount, they might just see that they're getting X amount of dollars. If they're getting a percentage of the will, they'll see the whole will. They'll be able to see who all the different beneficiaries are. Um, and and the executor will need to provide information to all of those as part of settling the estate. And there can be issues around that as well. And this is the alternative method, is you can name a donor advised fund to receive those. And then the donor advised fund is the only charity that the executor is dealing with. And then the funds will be distributed to those receiving charities, or, as per your instructions, without them seeing the will instruction. One other scenario that may be of interest is naming or creating a charitable family foundation within a donor advised fund. So you might have a larger sum of money, lifetime or through your estate, that you might set up, in this case with Abundance Canada. It's going to be in a gifting fund, and then you, or maybe your whole family, contributes to that fund, and then you or your whole family make the distribution instructions. So this could be something, we have people who will create a fund like this later in life or through their will, and they want to have steady support to charities going forward, maybe over 5, 10, 20, 20 years, 30 years. Some people might want it to be indefinite. Depends on what's important to you in terms of time frame and what's important to how best to support your charities of choice. So summary, we looked a little bit at what is planned giving. We looked at gifts of securities as well as life insurance and gifts of your will as well. And there's a variety of benefits for those different avenues. We're going to turn it back to Julie to open it up in terms of, in case there's any questions that people might have at this point.
Great. Do you want to stop sharing your screen here? There,
How's
perfect.
that?
Yeah, that's excellent. So I will open it up to questions. I don't see any in the chat yet. If you do have some, feel free to put them in the chat. I did have a question though, Harold. One of the things I've heard a lot about is the AMT, or some of the things that happened with that this year. Could you describe what that is and how it impacts some of these donation receipts?
Yeah, so last year in 2023, the federal government said they were going to introduce an alternative minimum tax rule change. So alternative minimum tax, we all do our taxes every year, and we have a standard rules about how we do it. But if we have a significant tax event, it could be selling a business or something else, we hit a threshold at which we bump into alternative minimum tax, which is a secondary method of calculating our tax bill. And so they were introducing a variety of rule changes. They said they would introduce them. Those were that the threshold would be higher, but there was going to be some other changes. So if somebody was going to donate securities, only half the donation receipt could be used in the year of donation. The rest would have to be carried forward. The capital gains, like I said before, capital gains, when you make a gift in kind, is zero rated, but they were going to include a portion of the capital gains. And there was a couple of other changes as well. So it was a fairly significant change that was actually negative to people who wanted to be generous to charity in their when they're making a larger gift at the time of a larger tax event. Those rules weren't enacted in 2023. We are waiting to see if there might be something in 2024, but there was a significant pushback from tax specialists and charities to the federal government saying, you might want to reconsider this because this could negatively impact the scenario where people with a larger tax bill from the sale of a business would want to be generous. Now they will be disincentivized. So we're waiting to see whether this will actually come about or not.
Great, thanks. Any other questions that people have? I know we're about 5 minutes left in our meeting time, so I just want to note that. And also, if people do have questions, they can for sure email us and we can get them to Harold, or they can connect with him, or we can find his contact details for him, for sure. So these are sometimes big ideas that take a while to kind of sink in and to think through. And like I say, the recording will be on the website afterwards for a while. So people can feel free to look at it, to watch it again, and then to come up with questions they have at that period of time. Actually, the other piece I will ask, Harold, just briefly, the private shares. I know you mentioned they're a possibility, but some of our supporters have farms that are private companies. So just if you could briefly give the overview of what that means without a specific example, just so people are aware of what that looks like.
Okay. Typically, this is somebody has a corporation, farm or otherwise. They have shares. Often they have already done what's called an estate freeze. So now they have preferred shares, perhaps together with the common shares, or have already converted all theirs to preferred shares. They can donate some of those in kind if they have a willing buyer. So perhaps if they've done a succession plan and their children are buying the business from them, they can donate some of those shares, and the children through the business buy back those shares. They get a donation. Let's say it's $50,000 that they donate. They get a donation receipt for that, and the shares are immediately purchased back by the corporation. The benefit of doing that is you're converting the tax treatment of that piece from a dividend to a capital gain. So there's some tax benefits of that kind of a donation in the right scenario. So you'd want to talk to your tax specialist about that.
Great. Thanks so much. All right, then I think we'll wrap it up. Again, thanks, Harold, for joining us. It was interesting. It always takes me a while to get my brain around some of these pieces, even though I've heard them a number of times now. But it makes you kind of aware that some of the implications of these are complex, but also some of the impact in terms of savings, in terms of kind of future value of present gifts when you don't have as many assets at the front end. There's quite significant potential for that. So it's a good reminder of that for sure.
Excellent. Yes.
Great. Well, thanks everybody. Again, if you have any questions or if you would like to watch it again, feel free to contact us and we'll provide you with the resources you're looking at. All right.